Welcome back, everybody. Today, we're going to talk about bonds and we're going to talk about certificates of deposit and how they fit into your portfolio. And I'm going to start off by saying if you're under 30, 35, and you have a high risk tolerance, which means you're not going to freak out and sell your stocks for a temporary market crash, you really shouldn't be investing in bonds because right now their returns suck. And CDs are more for your emergency savings account. But let's begin. Let's start off with definitions. What is a bond? A bond is a debt instrument. If a corporation or a local government or a state government or a federal government needs money, they give out a bond, which is it is a piece of paper, or it used to be back in the day. I'm sure it's digital now. But it's basically a piece of paper that a corporation gives out to an investor that says, you're going to give me this amount of money, and I'm going to pay you this interest rate, and then I'm going to pay you back the bond in full at the end of the term. So corporation, government, whatever, they borrow the money, and they pay regular interest payments on it, and then at the end of the term, they return the bond. They pay the money back, and then they get the bond certificate back. The whole point of it is that it's just somebody borrowing money. They need money for whatever. They need to finance a long-term project, or they're just irresponsible with their spending, like the federal government, and they just need freaking money for whatever purposes they need. Now, if you're investing for the long term, you will eventually need treasury or very secure bonds that are backed by the federal government in your portfolio at a certain point in your life, and that is when you are much closer to retirement. Now, why do you need bonds in your portfolio when you're older? It's because it provides stability to your portfolio. When you're young, you want to be heavily invested in stocks, which you buy and you don't freaking sell, ever, no matter what happens to the market. You invest in broadly diversified index funds on a regular basis. Over time, even though there's going to be ups and downs, those stocks are eventually going to grow at roughly a rate of 10% before inflation. Once that happens, once you build your wealth, then you start transitioning those stock gains into bonds. And those bonds, since they don't really fluctuate in value, they can, but they're much less volatile than stocks. They help you preserve that wealth that you've built over time by investing in stocks. Because you don't want to be an old man or an old woman and you have 100% stocks, and then your portfolio tanks, and you have to start selling stocks at a loss just to pay your bills. You want to have a big portion of your portfolio set aside in bonds. So yes, bonds do have a use in a portfolio, but they're only for stability, and they're there because they have a low correlation to stocks. Now, correlation is simply a relationship between two different asset classes. For example, large cap U.S. stocks and mid cap U.S. stocks are highly correlated. They're not perfectly correlated, but they're highly correlated. So if large caps go up by 10%, mid caps will usually go up by 10 or 11%. All right, they show a positive correlation with each other. Bonds basically have almost no correlation, or treasury bonds, government bonds, federal government bonds. They have almost no correlation to stocks. So if you're older and your stocks tank and you have a certain asset allocation, your bonds are roughly going to stay the same or maybe even increase a little bit in value while your stock portion of your portfolio tanks. So what you can do is you can liquidate some of your bonds and buy stocks when they're down, which helps you make money in the long run. So it provides that foundation. It preserves your wealth and it provides that foundation. Now, the reason I say buy treasury bonds or short-term treasury notes or whatever is because corporate bonds are more correlated to stocks than they are to bonds. And you want that stability in your portfolio. So when you're older, when you're in your 40s and 50s, and depending on what kind of pension you have, you want to start transitioning your investments over to bond ETFs or bond index funds to preserve the gains that you have made throughout your investing life. Now, bonds have sometimes done well, depending on supply and demand, stock market crashes, and interest rates. Right now, the interest rates suck because the Federal Reserve is keeping interest rates extremely low, which means that semi-annual interest that the bonds pay is crap. I don't even think it beats inflation. So if you're investing in bonds right now and you're young, you're almost losing money because the value of the dollar is plummeting faster than the interest rate that you get for your bond. So just trust me. When you're young, and of course talk to a financial advisor, a fee-only one, that'll give you exact recommendations. But when you're young, you really don't want to be in bonds, especially if you have a pension or whatever. You should be almost 100% in stocks, broadly diversified index funds. And then as you get older and you get closer to retirement, then you start transitioning over. All right? That's bonds. Now we're going to talk about certificates of deposit. Certificates of deposit are offered by banks, and they're basically a way for the bank to kind of lock some of your money away, and pay you a slightly higher interest rate. So the deal is you can have your money in a savings account or a high yield savings account, or you can give the bank a little more assurance that you're not going to take that money out, and they lock it away and they pay you a slightly higher interest rate in return. Now, you use CDs, or you should use CDs, only for your emergency savings. Because just like bonds, bank interest rates suck right now. They are below inflation, at least to my understanding. So you're not making any money from your savings account. Your savings account is literally there to protect you from unexpected emergencies. And if you want to eke out a little bit more return from a certificate of deposit, then go right ahead. I personally don't want to, because in case I need my emergency savings, I don't want to have to access a CD and get some penalties for all that little extra interest I got. I'd rather just have a high yield savings account that I can access. That still pays me a good interest rate. So CDs are fine. Just make sure you understand the terms. Like if you have to cash out the CD before it matures, what kind of penalties are you going to have to pay? And if you really want to get that extra 0.05% interest rate, you can. But I don't think you need it. But that's up to you. So, in conclusion, you don't want to be buying bonds when you're young. And if you do buy bonds for your portfolio, you want to invest in federal debt because it has lower correlation to stocks. That's what you want. You want low correlation and you want stability. That's what federal bonds provide you. If you're buying corporate bonds, they have bigger correlation to stocks. So if your stock portfolio tanks, your freaking corporate bonds are also going to go down. Whereas government bonds, federal government bonds at least, are going to stay stable. And that allows you to reallocate your investment portfolio and buy stocks when they're on a dip. Now, that's the thing with bonds. And like I said, you want to do it later in life. With CDs, I don't recommend them overall, but if you really want to do them, whatever, just make sure you understand the terms and know that it's not an investment really. It's only there to provide you a little bit extra return from your emergency savings. And your emergency savings are there just to help make sure that you don't have to cash out your investments for any unexpected expenses, okay? Oh, and one more thing. Bond interest and savings account interest is actually tax inefficient because they are taxed at ordinary income rates, whereas stock dividends are taxed at capital gains rates. So, in conclusion, final conclusion, they're tax inefficient. You don't really need them if you're young, and you want to have CDs, maybe, if you want to put it in your emergency savings. That's it, all right? If you guys like this video, hit the frickin' like button and subscribe to my channel. You guys have a good day.